Welcome to JM Financial Mutual Fund's Equity Outlook. In this short video, we would take a look at how different economic and market factors behaved in the recent past. We will also share our view on the Indian equity markets, which may in turn impact the positioning of our schemes. The Nifty index was down by 2.9% for the month ended July 2025. The Nifty Midcap 150 index was down by 2.9%. Whereas the Nifty Small Cap 250 index was down by 3.7% in July 2025. Sector-wise, Nifty Pharma 3.3%, Nifty Fast Moving Consumer Goods 1.7%, and Nifty India Consumption minus 0.9% were the top performing indices, whereas Nifty IT minus 9.4%, Nifty Realty minus 7.5%, and Nifty Media minus 7.3% were the laggards. Global indices ended the month of July 2025 on a positive note. Dow Jones was up by 0.1%, Nasdaq was up by plus 3.7%, while Financial Times Stock Exchange 100 was up by 4.2%. The India Volatility Index VIX saw decline in July 2025. It was at 11.54 compared to 12.79 in the previous month, down by 9.7%. The Chicago Board Option Exchange, CBOE Volatility Index 2, saw a marginal decline in the month of July 2025 and was at 16.72, as against 16.73% on the previous month, down by 0.1%. Foreign Institutional Investor, FII, were net sellers for the month of July 2025. Net FII outflows were Indian rupees 24,723 crores. Domestic Institutional Investor, DII, bought stocks worth Indian rupees 60,939 crores, whereas mutual funds were net buyers worth Indian rupees 47,019 crores. Nifty 50 forward price to earning trading one standard deviation above the mean price to earning. Indian equities declined for the month across all market caps, with Nifty falling by 2.9%, marking an end of 4 months' winning streak, even while other developed markets continued to see a risk-on rally, with top gainers being Korea 5.7%, Singapore 5.3%, and UK 4.2%. Within major emerging markets, Thailand 14.0%, Indonesia 8.0%, Taiwan 5.8%, and China 3.5%. had significant gains, while Brazil, minus 4.2%, declined. The underperformance of Indian markets are partly led by muted earnings season. While aggregate earnings were broadly in line with estimates, the outlook remained muted, resulting in continued cuts in earnings estimates. For the NSE 500 universe, approximately 250 companies having reported their Q1 fiscal year 2026 earnings, sales growth so far is 7%, while earnings before interest, taxes, depreciation and amortization, EBITDA, and growth is 9% and 7% respectively. EBITDA growth of 9% for the NSE 500 universe is largely driven by cyclicals at approximately 12% and defensives at 5%. Within the NSE 500, the mid-cap universe is outperforming, with a top-line EBITDA and profit after tax, PAT, growth of 17%, 18%, and 24% respectively. Small-cap universe, profit after tax, PAT decline, including financials, is at 9% year-on-year, so far led by a large drag in profits from a few NBFCs and telecom sector-related stocks. Excluding the above-mentioned sectors, The small cap universe largely mirrors the NSE 500 trends. In terms of outlook, while consumer demand trends being mixed whereby volume growth in consumption categories continues to be challenging, but commentary from fast-moving consumer goods, non-banking financial companies and discretionary retailers points to early signs of rural revival aided by a normalized monsoon and improved credit availability. However, private capex visibility remains limited, while micro, small and medium enterprises (MSME) lending is reporting some signs of duress, which can alleviate concerns on lenders, especially when credit growth has been suboptimal. Enhanced fundraising activity in primary markets potentially impacting secondary market flows. The primary capital markets have been on a juggernaut to say the least, with over $12.4 billion raised year to date and $4.68 billion in July 2025 alone, led by a robust pipeline of qualified institutional placements and initial public offerings. While supply has been largely absorbed so far, the pace continues to rise and sustained issuance could test market depth. Foreign institutional investors, FIIs, turned sellers. FII net flows were negative for the month, and while on fiscal year-to-date basis remains positive, their ownership in Indian equities continues to slide. For the quarter ended June 2025, their ownership of BSE 500 stocks fell to a fresh multi-year low of 17.1%, down by 19 basis points quarter-on-quarter. At $14.8 billion, inflows from domestic mutual funds, DMFs, were robust, driving a 23 basis points quarter-on-quarter rise in their ownership to a new high of 11.1%. Direct ownership of retail investors remained at 8.4%. Reciprocal tariff delivered on revised deadline came as a shock than a surprise. US announced modified reciprocal tariff rates for all countries via an executive order on 31 July 2025 to be effective in 7 days, whereby compared to the Liberation Day reciprocal tariff rates, countries that were initially hit the hardest, Cambodia, Vietnam, Bangladesh and Thailand, successfully negotiated significant reductions. Cambodia's tariff rate was lowered from 49% to 19%, and Vietnam's from 46% to 20%. India, despite being at the forefront of negotiations, has not yet finalized a deal, and its 25% tariff rate now exceeds that of most of ASEAN, 19 to 20%. Further, an additional 40% duty, on top of the country-specific rate, will be applied to all product imports deemed the result of transshipment, although this has yet to be clearly defined. Importantly, the Office of the United States Trade Representative USTR will publish a list of countries and specific facilities used in circumvention schemes every 6 months. With the duty imposed on all countries, this should curtail opportunities for tariff evasion. Within Asia, only China and Laos face tariffs of approximately 40%. Most Asian competitors have largely similar tariff rates, Japan and Korea at 15%, the Association of Southeast Asian Nations ASEAN and South Asia at 19 to 20%. India is higher at 25%, but could eventually settle lower. This implies less scope for Asian countries to benefit from trade diversion and less scope for US to substitute. However, with higher relative China tariffs, there is still an incentive to shift supply chains, although not for tariff reasons. India now found itself in Trump's crosshairs, with a 25% tariff on exports to the US set to take effect from August 7, 2025. The move came as a surprise to Indian policymakers, especially given the positive high-level diplomatic engagement between the two nations earlier this year. Trump cited India's strenuous and obnoxious non-monetary trade barriers and criticized its continued trade and energy engagement with Russia. The punitive action, however, follows a well-worn script. First, a harsh tariff, followed by statements indicating that negotiations remain ongoing. Despite the headline-grabbing tariff, Indian officials have reaffirmed their commitment to a deal that is fair, balanced, and mutually beneficial. India has shown readiness to eliminate tariffs on certain products such as auto components and pharmaceuticals as part of its trade talks. However, sectors like agriculture and dairy are non-negotiable on account of the large population employed by these sectors. India's exports to the US in fiscal year 2025 were at $87 billion, 20% of India's exports and 2% of US imports. Select all products within chemicals, electronics, energy and pharma sectors had been exempted earlier from reciprocal tariffs. If the exemptions continue, exports of around $50 to $55 billion could be at risk. Automobiles and parts, food products, gems, jewelry, metal products, and textile sectors comprise more than 50% of total exports to the US. In our view, India is too important to be sidelined, economically, strategically, and geopolitically. Continued engagement, calibrated concessions, and a focus on domestic resilience will help India weather the storm and emerge with a more balanced deal. Global interest rates paused. Central banks globally seem to be moving from accommodation to pause. The External Commercial Borrowing (ECB), Bank of England, Bank of Canada, and Bank of Japan kept policy unchanged earlier this month. US Fed Chair Powell's comments have further pushed cut expectations behind. With transmission of a 100 BPS cut underway, currency pressures, trade uncertainties, rising core inflation, and more external rather than domestic growth hiccups. The RBI is also likely to keep the policy rate unchanged next week. Domestic macroeconomic developments, India fiscal situation, looking vulnerable in overall context. The fiscal deficit for Quarter 1. Fiscal year 2026 has come to approximately 3.3% of gross domestic product, or 17.9% of the budget estimates, BEs. More than in Quarter 1 fiscal year 2025, but lower than in the previous years. Going forward, there are two important trends to take note of. First, since personal income taxes were flat in Quarter 1 fiscal year 2026, they need to grow 21.7% year-on-year in the remaining FY 26 versus 10.2% growth in the corresponding period last year. This is highly unlikely, and the annual shortfall could be only partly offset by higher dividend receipts. Second, the front-loading of CapEx in Quarter 1 fiscal year 2026 suggests that it will fall 2% year-on-year in the remaining fiscal year 2026 versus a growth of 27.2% in the corresponding period last year. Overall, while fiscal spending definitely provided cushion from weak private spending in Quarter 1 fiscal year 2026, limited space is available in the remaining fiscal year 2026. High-frequency data, however, showing resilience. Strong flash manufacturing Purchasing Managers Index for July 2025, 58.4, and pickup in manufacturing, 3.9% year-on-year, within a seemingly weak headline Index of Industrial Production Data, 1.5% year-on-year for June 2025. weak index of industrial production data is largely driven down by seasonal slowdown in mining and electricity generation due to the early onset of monsoons and a cooler climate compared to the heat waves of last year during May or June. Fiscal year 2026 monsoon precipitation is above average, 7% over long-term average so far, while the more important variable of reservoir levels across the country is even better, 61% of capacity. The aforementioned trends do not indicate any real threat of food prices spiraling due to deficient rains and should do well for the rural economy. Headline Consumer Price Index inflation eased from 5.2% year-on-year in December 2024 to a 76-month low of 2.1% year-on-year in June 2025. This is the third lowest reading in 14 years, when the latest Consumer Price Index series began. With headline inflation touching the lower bound of the target range, there is increased expectation of another rate cut in this calendar year. Looking ahead, India will need to navigate the global environment carefully, as it depends on technology from trading partners in critical areas such as energy, electronics, defense, and aviation. The China plus one argument is no longer working the way it should, and Indian weakness in manufacturing is being exposed. The current handicap should be converted as an opportunity as the government incentivizes manufacturing and consumption simultaneously. Global trade, which contributed to job creation, may no longer help India. India will need to think out of the box, creating favorable conditions to promote domestic manufacturing, and that may be reducing goods and services tax rates and/or increasing subsidies to encourage manufacturing. We remain constructive on equities and expect markets to settle down in next few months with domestic-facing economy to revive ahead of festive season. Markets have consolidated for the past 12 months and has led to some derating. Further, we do think that foreign institutional investor flows will turn, which should provide some cushion. Going ahead, we expect credit growth revival, stability in asset quality, pickup in private capex and its secondary impact on industries to be monitored, along with RBI monetary policy announcement and completion of Q1 fiscal year 2026 result season.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.